is Mario Hernandez, and I'm going to be going over sensitivity analysis as a tool for capital budgeting. To start off, let's look into what sensitivity analysis is. It is a tool to create a business case or a business strategy to base decision making for business projects. It is based on assumptions that might be done in confidence and some that might be done by educated guesses. The idea is to use known inputs to calculate the best possible outcome for business proposals and whether the risk is worth taking. The primary goals of capital budgeting is to stimulate growth with capital at hand, allocating the company's resources and efforts in the most efficient way. This is usually a plan for the upcoming year, and it is an invested process where different managers from different aspects of a company will be pushing for their best interests. It takes proposed projects, analyzes them, compares them, and chooses which ones to prioritize based on risk, cost, and payout. Our assumptions are qualitative as they are uncertain. Building a model based on these uncertainties will yield an uncertain outcome, but one that is used to make decisions on things like project costs. How different approaches to fund a project will profit the investment, how much money should be allocated to a project so it doesn't overspend money while not missing on any opportunities. Additionally, how a project can be more profitable than others, and which ones fall outside acceptable risk. Bond prices and amounts issued can affect how much investors are willing to buy into a company's equity. How much interest rates they will be receiving is an attractive comparison to what they will be receiving elsewhere, and how the rate affects the overall bond price. Market building projects can also have certain cost to revenue ratios that compare them based on assumptions. What will be the cost at different points of the plan, at quarterly, at a yearly, and at a long term? And how much of a return should be expected as cost decreases or increases. Quantitative variables, in the other hand, are the known inputs that ultimately affect the outcome. Some act like what if? What if sales in this quarter? What if sales increase in this quarter? What if sales are lost to a near product? Or what if costs of goods sold increase? They can also be variables that provide a little bit more control, such as expenses that can be increased or decreased depending on the benefit. Would it benefit to increase research and development for a product? Will the marketing venture produce a better outcome if we invest more money into it? Will increasing benefits and bonuses keep more of the talent to the company? Finally, cash flows analysis can be used to predict the cash flow of a project and whether the cash flow will pay out long term to the investors and generate a profit. It can also help to determine when will the cash flow pay back its initial investment in the form of payback periods, and this can also be adjusted for the time value of money. Additionally, it needs to be determined how much value the shareholders gain from a given project through the means of net present values. Thank you very much. This has been my presentation on the sensitivity analysis as a tool for capital budgeting.